through. We have Neelotpal Sahai, who is head of equities and fund manager at HSBC Global Asset Management. Neelotpal, good to have you with us here. Thank you for your time. I mean, I don't think I should ask you whether you are surprised by the resilience, because it's a constant thing, right? Whatever you throw at the market is just been rock steady, and I think it's just been a function of very strong liquidity, which is coming in every day, but also a lot of cash which mutual funds are sitting on, right? Our colleague Nimesh had done a piece about 1.25 lakh. The number is a week old. It would be larger now. So just how do you navigate this? Do you think if, say, for example, the US tech sector takes a bit of a dive, it will have any impact at all here in the market?
Thank you for having me on the show. Yeah, a very pertinent question, and this is a question that we deal most often these days, is that why is the market so resilient? So obviously, a part of the answer lies in the fact that the wall of liquidity, which is very strong and continues to come at every day. So there was an event 2 days back, the union budget was presented. There was a bit of uncertainty and apprehension about the budget, what could come, and now that has also gone past. In fact, there is a sense of relief because there is a policy continuity which is there, both in terms of the tax regime, the slight increase there, but most importantly, in terms of where the direction of the government could have been with respect to the capex and consumption. There was an uncertainty about the fact that how did the government read the mandate, and this was the first policy action after that. So a lot of would have depended upon how they would have read the situation. But what has come out is a sense of broad-based continuity, which is there. Now, given the fact that what we continue to always maintain, that the most important thing is the corporate earnings, and in the last 3 years, the corporate earnings have become 3x to 4x for the Nifty companies taken together. And going forward as well, the expectations are in line with 13 to 14% CAGR for the next 2 years. Now, that's a consensus number. Unlike in the past decade, where the corporate earnings numbers were not met, we are meeting the corporate earnings number for the last 2.5 years or so. So if you combine all these factors of the liquidity as well as the corporate earnings remaining strong, and the average valuations also now having gone up on account of the higher ROE, is that there is, especially in the large caps, the valuations are fair. So I would tend to think that the money can continue to come in and still we can get the investable ideas at these levels also.
All right, Neelotpal, just hold on to that thought for a minute. We just have Loris Labs. The numbers are up for our viewers on the screen, and it appears a rather weak set of numbers, actually, because there's a big margin miss. Even the absolute EBITDA number has missed our estimates by quite a large a bit. Remember, on a sequential basis as well, this 14.5% odd compares to around 17%. When we are at CNBC-TV18 had spoken to the management last, they said at some point of FY25, they expect to give margins of close to around 20%. For starters, though, it's way below that. So we'll have to gradually observe how exactly, this margin trajectory improves, because we had quizzed the management and they said they're quite confident about the 20%, but growth needs to pick up and then margins as well will come about. For the time being, these set of numbers are rather weak. Well, hi, Neelotpal, and thanks a lot for speaking to us here at CNBC-TV18. Well, as you said, you prefer the large caps in comparison to the broader markets as of now, and that would make sense because valuation-wise, well, that still looks more attractive in comparison to what's happened in the mid-cap space. What are the sectors you like as of now? Banks, everyone's quite positive over there. The problem now is suddenly the FIs have returned to the selling side of things, and their largest exposure is to the banking names. So in spite of fairly okay valuations, you still have selling out there. What's your preferred sector?
So actually our preferred sectors are real estate and the industrial complex, the economy plays which are there. On the banks, we have a neutral to negative view, especially the lending banking sector. If you look at the wider financial sector, then we have got a more positive view on some of the non-banking finance companies, which are doing pretty well. And we also have got a positive view on the capital marketplace. But when it comes to the banks, we have a neutral to negative view, and that is because of now the weakening earnings momentum. Even though the valuations are among the most comfortable across all sectors, but we are now beginning to see first signs. Whether we can extrapolate the weak NPA trends or not, I'm not very sure. But still, the first signs of the NPAs have begun to come in, both from the banks as well as from select NBFC. So I would say yeah.
So this, neutral to negative call on banks is for PSU and large cap private sector banks, right?
Yes.
Both. Okay. What about real estate? You said you're constructive on real estate. There has been a taxation change in the budget. How does it impact listed players, for investors, retail shareholders who hold real estate stocks?
So firstly, a lot has been talked about the tax change in the budget, but let's look at the numbers, and then we realize that it impacts on the individual case-to-case basis. If somebody has seen huge price appreciation in their property, then for them, the new tax regime is better. On the other hand, if somebody has not seen the huge price appreciation and it is more or less in line with the inflation, then the old regime is better. Having said that, we should also note that the investment into investable in the Section 54 of the IT Act is still available in the new regime. So one can still save tax even in the new regime. But I also must add that the majority of the purchase in the real estate is for personal consumption. And there, the important factor is not the end taxation, but the more important factor is affordability and availability of housing loan. And affordability consists of the EMIs and your income levels. And EMI is dependent upon the property value as well as the interest rates. So I tend to think those are the more important factors than compared to the tax structure or the change in the tax structure which has happened. Now, having said that, let's look at some of the structural trend which has happened. For starters, demand continues to remain strong and keeping pace with the strong pre-launches as well as the pre-sales, the numbers that we see. One data point is that inventory to sales of top 7 cities is now down to 1.5 years as compared to 3.4 years in fiscal 18. The second data point with respect to affordability is among the best that we have seen in the last 15 or 20 years. That continues to remain very strong for the buyer. When it comes to the sector itself, then the disruption has also meant that the consolidation is happening in favor of the larger players, predominantly the listed players. So both from the property buying as well as investment in the property companies is concerned, that we continue to remain constructive. It has been an overweight sector for quite some time, more than 3 years or so. And across our strategies, we are constructive here.
Fair enough. Got that. Thank you very much, Neelotpal. We will leave it on that note for today. Thank you so much for joining in. I really appreciate you being with us today. By the way,